Welcome to RBC's Markets in Motion podcast, recorded September 11th, 2023. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today in the podcast, our thoughts on two sectors that are important to the cyclical value trade. Two big things you need to know. First, energy still looks interesting on our models despite strong outperformance as summer came to an end. Second, we remain market-weight industrials, but find it's been one of the more interesting sectors to discuss in meetings as we see pluses and minuses for the sector that may not be fully understood. If you'd like to hear more, here's another 5 minutes. While you're waiting, a quick reminder that you can subscribe to this podcast on Apple and Spotify. Now the details. Let's start with takeaway number 1. Energy still looks interesting on our models despite its recent surge. The thing that jumps out to us the most on our sector work at the moment is the extent to which energy outperformed within the S&P 500 as summer came to an end. We've also seen this for the Russell 2000 since the beginning of August. We've been overweight energy within the S&P 500 and find that despite the late summer move, the sector still looks attractive on our valuation models within large cap, and this is also the case in small cap. Earnings revisions are also in the early stages of recovery within both small cap energy as well as large cap energy, and have already made a move back into positive territory in the latter. Going forward, we are keeping our overweight recommendation on the sector intact, while acknowledging our energy strategist view that oil prices may be at risk of consolidation around current levels, which is a risk to our call. Let's move on to takeaway number 2. We remain market-weight industrials, but there are a lot of interesting nuances for the sector in our work. Ahead of RBC Capital Markets Industrial Conference this week, we've refreshed our work on the S&P 500 industrial sectors, and we are reiterating our market weight call. The sector underperformed the S&P 500 just a little bit in July and August, but only a tiny amount, and it actually stands out to us for its resiliency. From a strategy perspective, we like the sector's balance sheet profile. Strong long-term earnings growth expectations, which are now tracking ahead of the S&P 500, and we also like its positive earnings and sales revision trends. It's also worth noting that money flows have been favorable for the industrial sector this year. Admittedly, the sector's extremely expensive valuations are an offsetting factor, but we think the sector may be re-rating as it's in focus for one of the equity market's more appealing growth themes right now, reshoring and the domestic industrial revitalization in the U.S. A weakening U.S. economy and the decline in the ISM manufacturing gauge have admittedly been a lingering concern for industrials for many investors, given that the sector has historically underperformed when ISM is falling. As we dug into the data, though, one of the things we discovered is that the relationship between industrials' performance and ISM manufacturing trends has actually weakened in the post-COVID era, and this is exactly what it did back in the previous growth tech bubble in the 1999 or 2000 timeframe. This time, the building long-term growth appeal of the sector from reshoring may be influencing the performance of the sector more than near-term economic worries. Within industrials, valuations are attractive for some groups such as marine, transportation, air freight and logistics, and trading companies and distributors, but are elevated in others like aerospace and defense, industrial conglomerates, and electrical equipment. We also see deep divergences within the industrial sectors on our earnings and sales revisions work. Revision trends are strongest, or mostly positive on both an earnings and revenue basis, for areas such as building products, aerospace and defense, industrial conglomerates, machinery, and construction and engineering. But the revision picture is quite different for other industries like air freight and logistics, ground transportation, and marine transportation, as these are seeing more negative than positive revisions on both earnings and sales forecasts right now. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.